Hey guys, take a look at this indicator. It's called the NFCI. It's put out by the Chicago Federal Reserve. It's an abbreviation for the National Financial Conditions Leverage Subindex. It's a long term, but essentially what it shows you is how much leverage the average investor is holding in their account. We zoom out, this indicator has forecast every major market downturn over the last 45 years. So the silver vertical bars here show recessions, and this green line is this NFCI, this leverage subindex level. And essentially it works like this. The scale of like +3 to -3, 0 is the baseline. Anything above 1 is considered over-leveraged or a risky time to own stocks. Anything below 1 is very under-leveraged and a great time to be buying stocks. Essentially, though, the easiest way to read this, as long as it's below 1, you're safe. If we're above 1, heads up, we're at risk of a stock market correction. So take a look at when it's happened. Here, the recession of 75, it signaled that. Same thing here in 81. Remember Black Monday, October 1987? Look at that reading right there. 1.25, 1.3 right before that happened. Next highest reading, end of 99, early 2000, right before the tech bubble burst, right? Got there above 1. Here it got above 1, November of 07, early 08, right before the financial crisis. Barely got there in late 2011, and that's when we had that one big pullback in this bull rally we've had. And we've just been kind of cruising along ever since. Now, if we zoom in on this indicator, we can kind of see what's happened the last couple of months. Right back here in March, it did get up close, 0.6, but still didn't get above 1. The reason it got high is the leverage of the average investor goes up when stocks take a big pullback. So let's say you had $1 million in an account and you bought $1.5 million worth of stock, right? So you're at 50% leverage. Well, when that stock comes down 30%, the money you have invested represents a smaller percentage. The cash you put in is a smaller percentage of your total investment, so your leverage goes up, and that's why these guys start getting hit with margin calls, and we get short squeezes, and everybody kind of gets out of these stocks. And when that happens and the number gets above 1, that's when you generally have risky conditions. But believe it or not, the number right now are at about 0.31, so we are still below 1, and the infamous recession indicator still says it's time to stay in stocks.